Hello everyone, hope you guys are having a great day. I just wanted to record this video on how I use PS60 as a technical indicator to design my trading plan. This system was created by a man named Dan Shapiro, who is an excellent and inspirational trader, and I actually learned a lot from his charting. Um, I didn't learn directly from him. I actually learned how to use this system from one of his students. And once I started to get used to it, I really never had to guess where a stock was going. It really provides nice guardrails to developing traders and is overall a very simple way to chart once you get the hang of it, right? Just keep in mind, technical analysis is an art, and there's really no right way to chart, in my opinion. I encourage you to take bits and pieces from a lot of successful traders and make it your own to fit your own personality. And that's essentially what I did with my version of PS60. But with that being said, let's just get into the basics that pretty much remain constant with PS60. But let's get right into it. So, stocks trade from supply and demand to supply. Supply and demand is defined as any area where emotional buyers meet technical sellers and vice versa, right? We can design a good risk reward trade by taking breakouts, bounces, and rejects from key areas of inflection. Some people refer to this as a pivot. And we use moving averages, and I personally use standard pivot points on my charts, which is different from what I mentioned before. But essentially, moving averages, pivot points, support and resistance is going to be our major take profit zones, as well as Bollinger Bands. But I kind of just bunch that in with moving averages. But essentially, when we have all that on our chart, we could trade the channels between each moving average on our daily and 60-minute charts, right? Keep in mind also, technical analysis is one part of our system. We have to account other variables such as volume, ATR, news, overall market structure to design a good trade. Just because a stock is confirming a new channel doesn't mean it has to trade to the next one. We could design a good risk reward trade and a thesis to that idea, but if we don't have other driving factors such as option flow, volume, other variables, then a stock is really not going to move, right? So with that being said, if you'd like to use my indicator, it's called Yanni PS60, PS60 strategy on TradingView. You could copy it for free. And the reason why I like it is because there's a lot of moving averages on your chart. And with my indicator, it's transparent. So you can see more of the price action and still take into account all the moving averages we use with the system, right? And with PS60, we have many different types of moving averages, right? You have the 5-day moving average all the way down to the 200-day moving averages with a combination of simple moving averages and exponential moving averages. And the way that I structure my indicator is that the fastest indicators, meaning the 5 and 10-day, are bunched together with a light green background. And sort of like a traffic light, the slower the moving average becomes, it goes into like a traffic light kind of way. So it's green, yellow, red, with red being the 200-day moving average and the faster ones being the 5 and 10-day. That way I could just memorize the colors a little bit easier for me. And the Bollinger Bands are purple because purple is just my favorite color. So with that being said, the Bollinger Bands are going to be standard. Don't need to change that. But let's get right into it. So with our first example on PLTR, what I like to do is first identify a point of inflection, right? So when I look at this chart, there's basically two ways I would play this, right? One being a really big point of inflection, which is this 2750 area where we rejected once here, twice here, and we're testing it for a third time last Thursday, right? The second way you could trade this is what I like to call a sneaky pivot, right? And this is why PS60 is probably one of the best technical indicators. So if we zoom in on our daily chart a little bit more recently, right, we actually reject this 2688-ish area a few times, once here, twice here, and then a third time in pre-market. You could actually get an entry before a stock breaks out, because look at what we have here, right? We're trending above the 20 moving average, the 5 and 10 day moving average, as well as bouncing off this red 200-day moving average right here. As you can see, we bounce perfectly here and here. So when we reclaim those levels, right, we could take the breakout above this channel and have a few take profit points, right? One being into that 2750, second one being into the daily Bollinger Band, and my third target usually is a standard pivot point, which is just default on TradingView, by the way. It's just traditional standard pivot points, and here are my settings for it. And I also have it on an auto time frame, so I could see the daily, hourly, and 5-minute pivot points. A lot of people like to use linear regression. TradingView doesn't have a good linear regression, so I don't use it. I like pivot points a little bit better for my trading, but if you have another trading platform with good linear regression, I encourage you to use that. But anyways, essentially, when we take breakouts on PS60, we look for the channels between moving averages, right? So with this channel right here, when it confirms and closes above this area of resistance where we rejected twice, then we could start trading to the next area of supply and demand, which is this resistance point right here. And when we break that, we have room to the daily Bollinger Band and the pivot point. And you could even see here, I love pivot points as a bounce area as well. We actually bounced right off that and reclaimed above yesterday's high on PLTR. But notice we combine other variables in our system with elevated volume, right? If we were taking a breakout trade and we have very little volume, maybe we don't confirm to the next pivot point. So another example of PS60 working really well is NVDA, right? Now, PS60 is going to work for particularly high beta stocks. You could use it on pretty much any type of asset class, but essentially the high beta stocks are stuff like Apple, Amazon, NVIDIA, Tesla. Those types of names with elevated average true range, typically this system works the best. But whatever stock is really in play, meaning has news, has good chart pattern, and elevated volume, this would be used for. So let's get into this example with NVIDIA, right? As you can see right here, we had a downtrend get broken on this day, right? You can see that when we gapped up, we closed above this short-term moving average, right? The next day we did have news, but notice how we trade directly to the daily Bollinger Band, and when we reject there, we consolidate until the 5-day moving average catches up, right? When we begin to uptrend, we hold the 5 and 10-day moving averages, trading in between this daily Bollinger Band and this 5-day moving average. In between that range, we could design very good risk-reward trades. As you can see, this trended very strongly over the next few weeks, right? If we go to a more recent time period, when we break down off this downtrend, notice how the next area we bounce when we lose the 5 and 20-day moving averages, we trade all the way down to the 50 moving average, as well as the daily Bollinger Band. So say that we were shorting this downtrend, right? Or shorting this break of uptrend, right? We short into here. Our risk is probably going to be this new all-time high. But our initial targets are going to be this 20-day moving average and the Bollinger Band and 50-day moving average. So say we get short here, our moving averages start to trend downward, and we cover into the next area of supply and demand. Once we bounced off that 50-day moving average, notice how when we got back into the supply and demand, the supply area, we start to trade a little choppy until we can confirm above this moving average. Notice how we didn't close anywhere above this 20, but the day that we closed above that, we begin our uptrend back into the daily Bollinger Band. We rejected that daily Bollinger Band, started to hold these moving averages for some time, but then ended up trading back to the 50-day moving average where we had earnings, a good catalyst with elevated volume, and we traded back to our daily Bollinger Band holding the 5 and 10-day moving average. And now we're just consolidating above the 20. Now, let's say hypothetically we close above this 225 range. Hypothetically, we would have room to all-time highs, which lines up with this daily Bollinger Band. So I would expect if we get a close above this range, then we could trade up until here. And maybe if you want to have swing trade this trade, right, you would run a stop loss a little under here. And that should give you maybe like a 2-to-1 risk reward maybe. But that's with our daily charts, right? When we identify a good channel we want to trade on our daily chart, which has quote unquote room in between each moving average, we go to our 60-minute charts, which takes out the clutter for our technical analysis, and we could measure our moves on a more short-term scale. So with this example on NVDA, right? Say we want to take day 2 or day 3 from this breakout on June 1st, right? Notice how we rejected once here on our 60-minute chart, twice here on our 60-minute chart, and the third time we break out above this channel, right? Our first take profit point would be into this 165-ish area, which would be our hourly Bollinger Band. But since we have a lot of room on our daily charts, which we saw right here, so like this would be right into here. Or I'm sorry, this is June 1st. Sorry, so this is all the way back here. So we have room on our daily charts, right? We're uptrending above the 5-day moving average and trading in between the daily Bollinger Band. Our first target would be that hourly Bollinger Band, and our second would probably be that daily, as well as any pivot point. So if I just change this back to historical, let's see if it updates here. No, it doesn't, but let's say we had a hourly pivot point here. That would be our third take profit zone. And we could even use a trailing stop loss as this hourly Bollinger Band. Notice how right here we get a little bit of a bounce right here. And right here is a little bit less clean, but we do open at that Bollinger Band and reclaim it. We could even take a second breakout on day 3 right here. Once we get a close above this area of supply, we could run a stop loss on the last 60-minute close and take profit into the next hourly Bollinger Band. Here's another example of how you could design a great risk reward trade you can notice that there's a nice area of consolidation or a bull flag on our 1 hour chart. When it breaks above that channel, we have room to this hourly Bollinger Band, but notice how it doesn't reach all the way. Now that's why we have to take profits a little bit along the way, depending on the ATR of the stock. So off the top of my head, I don't know NVIDIA's ATR since it's split, but based on ATR, you might want to slowly scale out of your position until it hits this hourly Bollinger Band. So that is just another example of how you can use PS60. With Tesla, here's another example of how you could design good risk-reward trades. Notice how when we reclaim this 5-day moving average right here, we traded into this channel, got above this 717.50 area, and traded right to the daily Bollinger Band right here. On days where we had a very big down move, a little bit unjustifiable into this pivot point, that could also set up for a great bounce trade right here. And when it bounces, your take profit points would be these daily moving averages right here, the 20-day, and then into the 5-day. But I expect if Tesla could get above this area, 65 area, we would have a quick scalp to the 67 area and start to reject into this daily Bollinger Band. But essentially, that's how I would use PS60. Just breaking down the daily and hourly charts to find good risk-reward trades. And another thing I like to do is use bounces off the 20-day moving average on the hourly. So a trade that I took on Friday, for example, on PLTR was, there's actually two ways you could play this, right? You could have bounced this 20-day moving average on the hourly. So on day one, we had a very strong up move above this supply zone. We rejected once here, twice here. Elevated RVOL on day one. On day two, we can look for areas of confluence, I like to call it. So we have a daily pivot point right here. On our hourly charts, we have the 20 moving average. On our 5-minute, we have close to a pivot point, not exactly right there, but this 28.12 to 28 area is a big area of inflection for this stock, as well as 28.80 is a big resistance area. So on our 1 hour chart, we could look to bounce this 20-day moving average with a tight stop under that. So say we design a risk reward trade here, get it on the break and reclaim of the 20 moving average, and we sell into the next area of supply, which is this 5-day moving average on the 1 hour right here. We have almost a 5 risk to reward. So that's how I would probably bounce the stock on day two. And you could even try to anticipate this breakout here. I think that would be a little bit of a separate trade. So say you try to get the breakout into here, you would have to risk the previous 1 hour close. So I would probably risk into like 28.40 and take profit into here. So our risk reward changes to 1.5 unless you put a tighter stop on this trade. But that's why sometimes breakouts could be a little bit risky, and it's better to take the bounce into rising 60-minute support, because our real breakout trade was right here. To take a second day breakout into here, your risk reward changes a little bit. And notice how we rejected that hourly pivot point right there. So just a 5-minute view of our stock, right? We had that quick flush off the open. The 20 moving averages was near here. And say you even trade options here. This explosive move off that 20 moving average could provide you with a lot of gamma as the stock moved very aggressively up. But yeah, that is all for PS60. If you guys have any questions, be sure to let me know. If you want to get really good at finding these patterns, I recommend just making a list of the high beta stocks right here, or stocks you like to trade in general, as well as the S&P 500 and the NASDAQ and the Russell. And what I would do is just go through a bunch of charts and try to notice patterns of bouncing off moving averages or channels, and ways you could get involved in a stock when volume is presented. I would just go through all these charts on the weekend and build up that pattern recognition. Another way you could do that is also screenshotting charts that you like. So say, for example, I like this NVDA chart and I want to build some pattern recognition for it. I like to have like a Google Doc, or I personally use Notion to screenshot these stocks and their chart patterns and save them somewhere I could go back to and look at the stock at another time. But essentially that's all for PS60. And if you have any questions, be sure to let me know. Thanks.